Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Iron Mountain stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Iron Mountain is an information management services company. The company does records management, information destruction, data backup, and recovery services to more than 220,000 customers in 58 countries throughout North America, Europe, Latin America, Africa, Asia, and Australia. Over 95% of Fortune 1000 companies use Iron Mountain services to store and manage their information. It has underground storage facilities in the US and the rest of the world. But most of the company's 1,500 storage locations are in above ground leased warehouse space. The best known Iron Mountain storage facility is a 1.7 million square foot high security storage facility in Boyers, Pennsylvania. This location features climate controlled storage areas protected by armed guards. It began storing records in 1954 and was purchased by Iron Mountain in 1998. This is where Bill Gates stores his Corbis photographic collection in a refrigerated cave 220 feet underground. It also houses the original recordings of Frank Sinatra, as well as master recordings from Sony Music Entertainment. The company is headquartered in Boston, Massachusetts, and was founded in 1951. It trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 15 billion market cap. They're trading at $51 a share, and they have 290 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow every year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also positive each year. It did peak in the trailing 12 months. Revenue is a sales for the company, and that's really consistent year to year. It was the highest in the trailing 12 months at $4.4 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months at $2.5 billion. Below that is their operating expenses, and these are all the expenses not directly related to generating the revenue. And below that is operating income, which also peaked in the trailing 12 months at $900 million. They do have a lot of debt on their balance sheet, so they paid over $400 million of interest on their debt every year. And the bottom line of the income statement is their net income, which is positive every year. It was highest in the trailing 12 months, mainly due to this large gain in other income and expenses. Here's a breakdown of their revenue by country from 2013 to 2020. Their revenue hovered around $3 billion from 2013 to 2015. Then it broke through $4 billion for the first time in 2018. So about 2/3 of their revenue comes from the US, 1/3 from outside the US. This is their income statement from their latest quarterly report. This shows us the first 9 months of 2020 versus the first 9 months of 2021. And their revenue is $3.3 billion, $2.1 billion from storage rental, and $1.2 billion from services. A bulk of their revenue is records management, that's $2.4 billion. Data management is $400 million. Information destruction is $319 million. It's really important for certain companies or certain governments to have information destroyed so nobody can see that information ever. This company provides that service. And they generated $240 million from their data centers. Their revenue went up in every category except data management. It went down from $417 million to $400 million. The cost of revenue is $1.4 billion. Then you have selling, general, and administrative expenses, that's $760 million. Depreciation and amortization, $507 million. $130 million are restructuring charges. These are one-time charges when reorganizing your company. This could be when they're laying off a bunch of employees or closing a location and opening up a new one. Their operating income improved a lot from $509 million to $658 million. They do have a lot of debt, so they paid over $300 million of interest on their debt in the first 9 months of 2020 and the first 9 months of 2021. And the reason their net income was so high was this $200 million gain. Their net income was $390 million compared to $100 million. If you strip out that gain, it would only be $190 million. They recorded a one-time gain of $181 million from the divestment of their intellectual property management business. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They do spend a lot on CapEx each year, about $500 million a year. Every time they open up a new facility, that goes into CapEx. And that facility is carried on their balance sheet and depreciated over its useful life. Operating cash flow minus CapEx gives you your free cash flow. Most of their free cash flow goes towards paying their dividend. That's why people invest in REITs, for that dividend payment. In order to grow the business and expand, they mainly use debt. But they haven't been adding debt the past few years. It seems like they issue a similar amount as they pay off each year. So they're just rolling their debt. Here's their cash flow from operations from their latest 10Q. This is the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with your net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with the gain of $391 million. We add back depreciation of $347 million, amortization of $172 million. They had $47 million of stock-based compensation. We have to add back a $36 million provision for deferred income taxes, and we have to minus out that gain on the IPM divestment. They also pass through a gain on the disposal of property, plant, and equipment, so we have to minus that out. They had a cash outflow of $113 million in their assets and a cash outflow of $96 million in their liabilities. Even though they reported an accounting gain of $391 million, they actually gained $463 million of cash flow. Last year, they gained $627 million of cash flow. The main reason it was so much better in 2020 than 2021, they only had a cash outflow of $10 million in assets compared to $112 million, and a cash outflow of $13 million in liabilities compared to $96 million. Let's look at their investing and financing section. This is the first 9 months of 2020 versus the first 9 months of 2021. The top is CapEx, investments in property, plant, and equipment. They spent over $200 million in company acquisitions. Customer inducements of $5.1 million. You don't see that too often, inducements. An example of an inducement is promising a customer a discount. That induces them and encourages them to buy the product. They spent $44 million in contract fulfillment costs, $72 million in investments in joint ventures. They did receive cash from the divestment of IPM. The cash goes into the investing section, not the operating section. And here's the cash they received from the sale of property and equipment. In their investing activities, they had a cash outflow of $320 million. Last year was a cash outflow of $360 million. They paid down $2.6 billion of debt. They added $3 billion of debt. They spent $75 million on purchasing the equity from one of their non-controlling interests. If Iron Mountain owns 80% of another company, and say another entity owns 20% of that company, then the company that owns 20% is called the non-controlling interest. That means they bought out the equity ownership in the non-controlling interest of one of the companies they have a controlling interest of. They paid dividends of $539 million, and they received $20 million from selling their employees' stock. So in the financing section, they had a cash outflow of $178 million. Last year was a cash outflow of $307 million. This is the equity section on their 9/30 balance sheet. They have $974 million of equity. They raised $4.4 billion from selling their business, and they lost $3.1 billion from running their business. This is pretty common with REITs, because retained earnings is a sum of all your prior net incomes minus the sum of all the dividends you paid. REITs pay most of their earnings out in dividends, plus they pass through a lot of write-downs, mainly depreciation. So they have an accounting loss of $3.1 billion, but they're probably cash flow positive. Let's look at the capital structure. $1 billion of equity, $11 billion of debt. They're 8% equity, 92% debt. So they're pretty leveraged. I gave them the lowest WACC of 6.47%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $14.5 billion. We divide that by 290 million shares. And we get a calculated stock price of $50. They're trading at $51, so they're trading at a 3% premium. It's a sell according to the model. I did a video on this ticker almost exactly a year ago when they were trading at $30 a share. And my valuation was $51, which is pretty much where they're trading at right now. Their revenue is expected to increase 3.7% per year annually. So I grew their revenue 3.7% a year for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I took the 2020 number, I took the free cash flow over the revenue number, and that comes out to 13%. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. Simply Wall Street is a lot higher than me. They're at $91 a share. They're saying it's 44% undervalued. 5 analysts priced this stock and the average price target was $51. Their beta is 0.83, so the stock is less volatile than the market. It's gone up 75% in the past 52 weeks, while the S&P is up 27%. The 52-week low was 28, the high is 52. And the stock is trading above its 50-day and 200-day moving average. 1.5 to 2.5 million shares are traded each day on this stock. Of the 290 million shares outstanding, 286 million are on float, 81% are held by institutions, and it has a high short percentage. Over 14% of the shares on float are shorted. Their dividend yield is 4.8%, which is 112% of their net income, 273% of their free cash flow. That does look kind of odd, but if you look at it over a longer period of time, the dividend over free cash flow should be about 90%. It's possible they spent a lot on CapEx in the trailing 12 months. That's why their free cash flow is really low. Their industry pays a 2.8% dividend, so they're a lot higher than the industry. Their employee count is up a little bit over the years. It's fairly steady the past few years. They currently employ 24,000 people. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $37,000 today. That's a 275% total return, a 14% annual return. In the past 12 months, it looks like there's no insider buying, just some selling. 7,000 shares, 1,800, 3,500, and 2,000. All of these people would have been better off watching my video and waiting until the stock price came up, because they sold below where it's trading at now. 80% of the shares are held by institutions and 19% by the general public. The biggest shareholder is Vanguard at 17%. They own 49 million shares valued at $2.5 billion. Then Capital Research, BlackRock, State Street, and Geode. Let's look at their financial ratios. They have a PE of 23. That's between the market median and average. PE is stock price over earnings per share. They have a good price to sales of 3.4 and a pretty high price to book of 15.3. Here's a list of their non-current assets. They have $4.6 billion of property, plant, and equipment. That's after depreciation. $4.5 billion of goodwill. Goodwill is a premium you pay when you acquire another company. $1.2 billion of customer relationships. $2.3 billion of operating lease right-of-use assets, and $366 million of other. Their return on invested capital is 6%. They do have a lot of debt, but they can cover the interest payments on their debt more than 2 times. When a company has a lot of debt, they can inflate their ROE. Their ROE is 65%, which is really high. And they have a low current ratio and quick ratio of 0.7. Let's look at their current assets. They have $161 million of cash, $884 million of accounts receivables, and $223 million of prepaid expenses. Let's look at their current liabilities, $318 million on the current portion of their long-term debt. That means it's long-term debt, but it's due within 12 months. $320 million of accounts payable, $926 million of accrued expenses, and $258 million of deferred revenue. It does seem like they're undercapitalized. They did generate $263 million of free cash flow in the trailing 12 months, but they have negative 557 million in working capital, and they pay out over 700 million in dividend payments. So it looks like they're going to be short $1 billion, so they're going to probably have to add some debt over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 9 companies in the same industry as IRM, and if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. When you look at a REIT, you should look at the price of the stock over funds from operations per share. Funds from operations is net income plus depreciation and amortization minus the gain on the sale of real estate. And for this ratio, the lower the better, and the average is 38 and they're at 19. Their PE is much better than average. Their price to sales is also a lot better than average. They don't have a good price to book. They have a pretty weak balance sheet, lots of debt. They have a bad current ratio. They have an amazing ROE, the best on this list. And they're really high in debt, higher than average. And they're 15 billion market cap. The average is 35 billion. And they pay the highest dividend on this list. Here's a list of all the companies in their industry. And this is sorted by market cap. And this shows you their revenue in 2020 and their dividend. Iron Mountain is right here. Gaming and leisure properties pays a 5.5% dividend. Weyerhaeuser is 5th in market cap, but they have the highest revenue. That's pretty interesting. It's something to consider. If they have so much revenue, it could be a good value. To summarize, I have them trading at a 3% premium, but I do like this company. I like what they do. They do provide a really important service that's used by so many companies. They do have a lot of debt, which I think is a big concern for a lot of investors. But that's just part of being a REIT. You need to take on debt in order to grow because you have to give back most of your profits to your investors in the form of dividends. So it seems like a pretty safe investment, but I don't see as much upside as I did last year when I did this video. I ranked their free cash flow as 5 out of 10, their revenue 6 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.